I'm glad to be here today, and I want to talk about trading weekly options today. And we have two strategies, and I'm just setting up my okay, good. I'm just setting up the presentation, and today we're going to look at two weekly option strategies, the option purchase strategy and the weekly option income strategy. And at the end, I'd be glad to have the Q&A session with any questions you may have. And I wanted to show the current trade results for these two strategies. So what I did is I included snapshots of my two brokerage accounts, and currently, as of today, have $471,000 in open trade profits trading the strategies. And over the past 10 years, we've also collected over $9.9 million from selling option premium from the option income strategy that we'll take a look at after the option purchase. So those are current real-time results for the strategies that we're going to look at today. And some of the advantages of weekly options is they expire every Friday. So you have plenty of trading opportunities throughout the year with weekly options as opposed to monthly options. Because they expire every Friday, you have 52 opportunities each year to trade. So this gives you plenty of trading activity. And what we do, and we've been doing this for many years, is we roll over our weekly options, whether it's an option purchase or a covered call. We roll that over and roll over the profits from the closed out trade into the following week trade. And for most of our positions, our cost basis is close to zero or below zero because we've collected enough profits to cover all the costs of the new trade coming up. So that's a big part of our program. We roll over. That way we can reduce our risk and compound our returns and reduce our risk to a minimal amount. And one of the other benefits of weekly options is you can start out small, and I'm going to show you an actual portfolio of weekly options, and the total investment was $270 for the whole portfolio. So you can start out small with weekly options. So the two overall goals for the strategies we're looking at today is price appreciation and profits with weekly option purchases, and then generating income from the sale of option premium with weekly covered calls. Let's look at the option purchase strategy first, and let's just talk about the risk in general with trading options before we get started here. Options are leveraged, and they provide more profit potential compared to stock investing, but that leverage also incurs more risk. So what I'm showing is a option chain for Home Depot, and at the time, Home Depot stock was trading at 77.73, and if you were to buy the at-the-money call option at that time, it would have been the 77.5 strike call. So the bid and ask is 320 by 330. So if you were buying this, you'd probably buy it at 325 or 330. So let's just look at the risk of buying the 77.5 strike call at 325 and Home Depot stock trading at 77.73. So what I'm displaying now is our call option purchase calculator, and the Hughes Optioneering Team has developed 6 different option calculators that we use for our option strategies, and they allow us to determine the profit loss potential for a trade before we take the trade, and the calculators are based on various price changes in the underlying stock at option expiration, in this case from a 10% increase in the stock to a 20% decrease in the stock. So this will calculate the profit potential for this call option purchase. And we can see if Home Depot stock is flat at 77.73 at option expiration, we're going to incur a 92% loss on our option. And if the stock is down at all at option expiration, then we'll have a 100% loss. So that's the risk you face when you're trading options. You risk 100% loss of the premium if the trade goes against you. So, and in this example, Home Depot actually closed at 75.38 at option expiration, so that would have been 100% loss on this trade. So I like to look at the risks involved before we get started here, just so you know that when you trade options, you're risking the premium. So option trades can result in 100% loss, and the goal of Prime Trade Select is to avoid those large losses which can knock you out of the game. This is a snapshot I took today. This is the VIX index over the past year. Of course, that's the fear gauge, the VIX volatility, and you can see that every one of these spikes in the VIX was a market sell-off. So when you're trading options and your timing is bad and you hit one of these sell-offs, then you could easily lose 100% of your premium. So our goal is to avoid those large losses. So I've been investing in options for 30 years. I started out trading options with a $4,600 trading account, and in my first 2 years of trading, I had over $460,000 in profits, which is more than I made the previous 6 years as an airline pilot. And these are just tax returns for those first 2 years of trading, showing that $460,000 in profit. So I started out small trading options and have done very well since then. So we use what we call Prime Trade Select to select option trades with a high probability of success. So it's a three-step process for selecting options. First, we want to determine the price trend of a stock. Step 2 is we want to confirm that price trend. And then step 3 is we want to select a low-risk entry point using the Keltner channels. And we purchase call options on stocks on a Prime Trade Select buy signal, and we purchase put options on stocks that are on a Prime Trade Select sell signal. And Prime Trade Select works in both bull and bear markets and was very profitable during the last 2 bear markets. So in 2008 and 2001, 2002, we had short positions using Prime Trade Select to select bearish positions, and we did very well during those bear markets. So it works in both bull and bear markets. It's a simple trend following system, and it just follows the trend. So Prime Trade Select step 1 is we use a simple trend following system to determine the price trend, and as I mentioned, these trend following systems did get bearish during the last 2 bear markets, and we were profitable. And with trend following, the goal is to quantitatively measure the buying and selling pressure of a stock. And if we're trend followers, it allows us to follow the trend instead of trying to predict the trend. And we like to use a system instead of emotional decision making. And I've been using the trend following successfully for more than 30 years now. And we use an EMA trend following system, and we use the 50-day exponential moving average in relation to the 100-day exponential moving average to determine if a stock is on a buy or a sell signal. So if the 50-day EMA, which is the shorter term, is above the 100-day EMA, then that stock's on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal. Here's an example of a Prime Trade Select buy signal. This is for the Dow Jones Internet Index Fund, symbol FDN, and this displays the daily price chart of FDN ETF, and the daily price movement are these vertical black and red lines here, and then the blue line is the 50-day EMA, the red line is the 100-day EMA. So we can see the 50-day EMA is above the 100-day EMA, so FDN is on a buy signal. And as long as the blue line remains above the red line, which is the 100-day EMA, then that stock is on a buy signal, and it remains on a buy signal until this 50-day EMA blue line crosses below the red line, and then the stock is on a sell signal. And this FDN is a great way to trade the FANG stocks. And as a matter of fact, today I did an FDN trade. We rolled over from our December FDN option to February. So we went 2 months out on FDN, and now FDN's trading at about 108. So I actually made a trade today in FDN, and we continue to hold that. That's a good way to trade the FANG stocks in an ETF.